Hello ladies and gentlemen, welcome to today's webinar. I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's outlook and most of all today's session, today's webinar, we will talk a little bit about our risk management strategy, and most of all one of the most appropriate risk management strategies that you can use to evaluate your particular trading strategy at the moment and implement it properly to any trading plan. However, of course, the particular trading strategy or risk management strategy in this case can also be readjusted. It could help you here and there if you want to better fit it in your current trading plan, as well as our previous teachings, our previous webinars have shown that the particular way of development is, the trading plan as it is, the basic structure of it has helped a lot of our traders at this stage to subdue their losses on the market and help them for the time being to stay on top of any situation, and most of all to at least cause less damage to your trading accounts, to the balance of your trading accounts. And some of the traders, however, were quite curious of how they can expand the so-called properties of the structure, so they can implement it much better to their existing trading strategies. And they have actually found out that in some cases the trading strategies that they're using are simply not fit for the long run. So the base structure of the trading plan that we've developed in the past helped our traders to limit their losses, and eventually the profits are not far behind. So one thing I actually hate doing is to start beating myself in the chest to show you guys how well we're doing and how our tools are helping you in your own trading. So that is why I'm not going to say, or let's say ever going to say, how good the performance of our traders is. This I will leave to their own judgment, and of course you are more than welcome to criticize anything that you see, that you think that could be amended in some point of time. This is also the case of today's session. Our Forex risk management strategy could also be amended here and there, implemented with new tools, and if you have some more ideas about it, I'm more than welcome to hear all about it, to also name the people that, or the person that is responsible for, for the good ideas. And as I mentioned the last time, I am also a person that is learning every day from, let's say, the experience of my traders, their flaws, their success as well. So I can so I can help in the future more and more traders to establish a good trading plan, a good trading strategy, and furthermore to increase their performance of their accounts. Making a success rate, ladies and gentlemen, to work for you is one of the most powerful skills of the professional trader. This simple guide that I will introduce today is the concept of even giving equal weight to all of your position and always control what you risk. Today's content will be the measurement of a success rate, equalizing our positions. We will also see a few base techniques on how to to measure our success rate, also what it means for us, and furthermore to that we will also see how to choose our risk level by giving a few very basic examples of some chart patterns which are pretty much the base of our day-to-day trading. So what is a success rate in general? Quite simply put, the success rate is the percentage of profitable positions in terms of the total number of positions a certain trader places. If, for example, a trader has a success rate of 60%, then we can safely say that 6 out of 10 of his positions are profitable while the rest are losing. On its own, for example, this rate means absolutely nothing to our performance, that is. But with the right approach, we can make virtually our success rate to turn a consistently losing account into a consistently profitable account. That means that when we measure our success rate, it is definitely easier actually than it actually sounds. We have two options. Now, we can simply review our past positions on a regular basis to count how many of our positions are profitable, and using the simple formula to, for example, to put our positions closed in profit and subtract it from total closed positions, we can arrive at our success rate, as I mentioned a couple of minutes earlier. But what does, in fact, our success rate means for us particularly? The success rate, ladies and gentlemen, is extremely important as it can show us if our trading strategy or style is absolutely suitable for our type of trading, or for our behavior in the market, or our state of mind from a psychological standpoint. For example, if we're trading a strategy where our stop loss is always 4 times bigger than our take profit, then this strategy would not be suitable if our success rate was equal or less than 80%. Why is that, and what does that mean? Because if we win 8 trades with $100 profit and we lose 2 trades with $400 loss each, our net profit would be equal to 0. Or even less if we have kept our positions overnight, or even if we count the commissions that we charge. So this can definitely result in a loss. The example so far of course assumes that our positions are always of the same size, same cash stop loss, same cash take profit. But if they weren't, then the success rate would have had little or no meaning whatsoever, and even if it was higher than 80%, we still wouldn't have a guaranteed profit. Let's consider a few simple examples where our success rate is once again 80%, but our stop losses are only 3 times bigger than our take profit. We will assume we had 4 winning positions and 1 losing position. Once again, that is still a success rate of 80%. But our strategy can now be sustained by it due to this better stop loss and take profit ratio. Okay? The positions are of different size. Some of them have a small potential and small stop loss, while others have bigger potential and bigger stop loss. Let me just grab a tool here. Oops. Now, if, for example, we have number 1, a TP, or a take profit, of $20 and a stop loss of $60, Now this is the example that we will work forward. Number 2, I will just quickly write them down here without adding any take profit on stop loss. You can simply take it as a consideration like this. Then we have a stop loss of 90. This is, as you can see, 3 times 3-to-1 success profit risk ratio. We have number 3 of let's say 40 here, and obviously 3 times bigger, 120. Moving forward to number 4, we have about 50. 3 times bigger makes it 150. Number 5. Sorry for the ugly writing here, ladies and gentlemen. It's a bit difficult to write with the mouse here, so I apologize to all of you. 180, 3 times bigger than the take profit of 60. Now finally, let's assume our first 4 positions have hit, for example, their take profit targets, while our last position hits our stop loss. So that would be 20, 30, 40 plus 50 minus 180. This would equal a total loss of $40. If we consider, however, the same example with all positions having the same take profit cash potential and stop loss potential, then the result would be quite different. Then we would have, if all of them are with take profit of $20 and the last one have a losing position of $60, then this would equal to a plus $20 of profit. Therefore, if we want to make the success rate work for us, we need only 2 things: a strategy that could be sustained by our success rate in terms of stop loss and take profit ratio, and second, all our positions must have the same cash potential. I will demonstrate how this can be achieved in taking the next headline here. So choosing the right risk level is a very important piece of the puzzle. So the first thing we have to consider now when looking at a new strategy, for example, or a trading style, would be how much of our equity we are prepared to risk per position. There are 2 popular approaches, however, which I stand to keep them as the most safest way of trading. The first one is the type of so-called passive trader, number 1, that uses the 5 to 15 rule. That means we do not open a position where the possible cash stop loss would be bigger than 5%. This is from the total equity. We also do not have more than 3 positions on different instruments working at the same time. For example, let's have an example of $10,000 account. It's easier to calculate. Now we can open a position, one position, with a maximum stop loss of $500. If we want to open multiple positions, let's say 3 positions at a time, on different instruments, their combined stop loss also should not exceed this $500 stop loss. Also, the second example here is the second type of trader is the aggressive type of trader. The rule of 10 to 30 is used in these cases where the position with a possible cash stop loss wouldn't be bigger of 10%. We also do not have more than 3 positions on different instruments working at the same time. So again, 3 positions. The same example with $10,000 account, we can open 1 position with a maximum stop loss of this time is $1,000. And if we want to open multiple positions, their combined stop loss should not exceed also $1,000. Depending, of course, on the percentage of our equity that we are prepared to risk in the single position, we can arrive at our preferred risk level. If we have chosen the 5 to 15 rule, for example, on $10,000 account, then our stop loss per position should not be larger than $500. This number, of course, is quite important as it will be the constant of which we will build our risk management approach from this point on. So let's consider a simple example that you see below here is where we will start giving equal weight to our positions. So let's consider a simple trading strategy that involves our double bottom and double top chart patterns. We will notice that because of the almost equal stop loss and take profit, this style particular would be suitable for any success rate above 50%. That is why I've chosen it, and I keep using these particular type of patterns due to the strategy itself. As I mentioned, it is always suitable for an account in a strategy with above 50% success rate. So if we take a close look, we will notice that some of these formations have, for example, a stop loss of 25 pips because the formation is smaller, while others have bigger stop losses, sometimes of more than 100 or a few hundred pips. And professional traders deem to see those formations as to have a success rate of more than 90%. Now, if combined with the right entry technique, naturally, we would not win more than 20 pips 9 times just to have it all loss if we hit our stop loss on a bigger formation. That is why we can make all positions equal to that. We will have a consistent net profit sustained by our success rate. Now, we have already decided that let's take the more aggressive approach of a 10% because it's a more easier way to calculate and it will be easier for you to understand, or of course to some of you, because the more experienced traders at the moment will be having absolutely no trouble, even if I decide as a number of any kind. So $1,000 of stop loss is the first parameter in our formula. The second one would be the pip difference between the entry level and the stop loss level. Based on those parameters, we can choose a different lot size for every position so that they will have the same possible cash loss or stop loss if it's hit. In this way, we will not be hurt by bigger positions that, for example, can go wrong either way. Back to our example, if we have decided that the $1,000 is a good risk level for us, we could equalize our positions by using the formula over here. I will just write it down. So that's 1,000. I'll be writing a little bit slower so you can of course, read much better. The number of pips to stop loss equals to the cash per pip. Cash per pip. From cash per pip, now we can arrive on the number of lots we want to buy or sell in the case of, let's take an example with the euro-dollar for one lot position per cash per pip. Cash per pip is $10. So let's assume double bottom formation on the euro-dollar with the stop loss of 45 pips and a take profit of 37 pips, for example. Okay, now here I have a very limited space, but let's say I'll just write them here. Take profit of 45. Profit, sorry, that was the stop loss. So the 37 take profit against a stop loss of 45. Now, according to the formula, we can open a position with about 2.2 lots is what it equals. Position number 2, this will take as an example in our future calculations down here. A double bottom of euro-dollar with a stop loss of 100 pips and take profit of 85. Take profit of 85. Stop loss of 100. And number 3, firstly, here we have a one lot calculated. On the double bottom, euro-dollar with stop loss of 215 and take profit of 200. Take profit of 200 and a stop loss of 215. We will have an equalized position of 0.47, or we can of course make it 0.5, half a lot. Now, if the first two of those positions were profitable, let's say, and the last one was a losing position, because as we can see, it's the bigger pip size and the smallest lot size, we can see that the difference in our net profit loss, if the positions were opened with the same lot size or with the different lot size, we have calculated to have become, for example, of a same lot size. I will write them down here. Same lot size, we will have position number 1 have made a profit of $370. Position number 2 have made a profit of $1,000, as we have assumed that the first two are profitable, and all of them with one lot, 37 pips, $370, and of course, so on and so forth. Now, the third position here would have a loss of $2,150. Now, the net P&L comes at negative $780. This drives us to our next example. This will be our equalized positions. The first position, as we see the example up here, will have a profit of $814. because as we can see, that's 2.2 lots. You can calculate it along with me. And if I'm making any mistakes here, because I'm calculating at the moment, please be so kind to correct me. Position number 2 takes a profit of $1,000. It's much easier because it's a one lot position. And the third, we have a loss of $1,010.50. The net P&L comes at positive $803.50. Now, how good is that? On equalized position, we get a profit by the same circumstances as the same lot size, but here we're on a loss of $780. In here, we're on a profit of $803.50. So this simple approach, ladies and gentlemen, can be applied to most trading plans and styles and is an integral part of the professional trader's arsenal. It will allow you to stay on top of the numbers and make them your friend instead of leaving your account at the mercy of the market. Conclusion to the whole thing comes to say that the bigger the pip size of stop loss and take profit, the smaller the lot size. The smaller the lot size, the bigger the lot size. So you see, everything can be made to work your way. With those simple examples here, we were part for today and for this week, of course, but next week comes our important session, and we will talk federal interest rate hike revealed. Now, in this session, we will take a look at a few numbers, what exactly the Federal Reserve is looking for to see on the market besides the things that they're saying. What exactly can be squeezed out from the speeches of Fed officials, mostly from the Fed Chair Janet Yellen. What she is actually trying to say, but she's not saying it, or basically, we will break down to pieces important details that investors and traders are looking at to place their positions and to better position themselves ahead of major events. As it is, 16 of December, we have Federal Open Market Committee interest rate decision. Thank you very much for joining us today. It was a pleasant session one more time. And of course, I will see you next time on Thursday, same time. Thank you very much for joining us. See you next time. Bye-bye.